According to Free Malaysia Today, French domestic intelligence, the DGSI, is ending its relationship with American data analytics and AI heavyweight Palantir, and this move is stirring up some serious discussion in the investing community. Welcome back to the podcast, where we look at how political decisions, regulation, and technology shifts translate into risks and opportunities for investors. In this episode, we dive into what France's decision means for Palantir, for U.S. tech dominance in sensitive sectors, and for anyone holding or watching PLTR stock. According to Free Malaysia Today News, French Prime Minister Sébastien Lecornu announced that France's internal security agency will no longer work with Palantir. The Prime Minister paired this announcement with a substantial public investment plan to build domestic artificial intelligence capabilities and reduce dependence on foreign, specifically American, digital infrastructure. The key political message was clear: France does not want to be strategically dependent on U.S. tech companies for critical security tools. From an investor's perspective, this is not just a one-off contract issue. It is part of a broader narrative around digital sovereignty and de-risking from U.S. providers that could shape Palantir's international growth trajectory, its valuation multiples, and the risk premium investors demand on the stock. Let us unpack this in several layers: the immediate contract implication, the political and regulatory backdrop, the signaling effect across Europe, the impact on Palantir's business model and valuation, and finally some possible scenarios investors might want to consider. According to the report, the trigger for this renewed sovereignty push was a U.S. decision to cut off access to Anthropic's powerful Fable model for users outside the United States. That move, which walled-gardened a critical AI resource, alarmed European policymakers. It demonstrated that Washington can effectively flip a switch and constrain access to a key technology stack for non-U.S. actors. French leaders immediately connected that incident to the broader issue of relying on American platforms for sensitive capabilities. Palantir, which is deeply embedded in U.S. national security, intelligence, and defense, became an obvious focal point. From a political optics standpoint, continuing to rely on a company tied closely to the CIA and to U.S. national security policy looks increasingly uncomfortable for European governments that want autonomy in both defense and digital infrastructure. For investors, the Anthropic incident is important because it illustrates the risk that foreign governments see in over-reliance on U.S. tech. Even if Palantir does not do exactly the same kind of switch-off, the perception risk is what matters. If European policymakers believe, rightly or wrongly, that U.S. authorities could influence or constrain access to Palantir's tools in a geopolitical crisis, that alone can drive contract decisions. The article notes that France is putting substantial capital into domestic AI development to create national alternatives. While the piece frames this primarily as a security and sovereignty issue, it also hints at a major redirection of government budgets. Money that might have gone to Palantir licenses and services could instead support French or European vendors, open-source consortia, or in-house projects. For Palantir shareholders, this means one thing: in certain countries, especially within Europe, the replacement risk from politically favored domestic solutions is rising. Even if those domestic offerings are not as mature or capable as Palantir's platforms today, the policy tailwind will help them catch up over time. That puts a ceiling on Palantir's pricing power and long-term share of wallet in those regions. According to Free Malaysia Today, the decision by the DGSI is explicitly framed as a reaction against new strategic dependencies in the digital sphere. Strategic dependency is the key phrase here. It is not about price. It is not even primarily about technical quality. It is about control, leverage, and the ability to continue operations during crises without being subject to another state's decisions. From the standpoint of a PLTR investor, this raises several questions. How much of Palantir's thesis relies on being the de facto operating system for Western democracy's security and critical infrastructure? How diversified is the client base geographically? How dependent is the long-term growth story on expanding into European public sector contracts versus deepening U.S. government ties and broadening commercial adoption? Palantir's close alignment with U.S. interests has always been a double-edged sword. On one side, it gives the firm unique access, credibility, and long-term contracts with the U.S. government. On the other, that same alignment can be perceived as a sovereignty risk by other governments, especially as global politics become more multipolar. France's latest move is a reminder that this trade-off is not just theoretical. The article also reminds readers that Palantir was co-founded by Peter Thiel, a prominent right-leaning Silicon Valley investor who is close to former U.S. President Donald Trump. It emphasizes that the firm had support from the CIA at its inception and that it has worked on highly controversial projects such as tracking undocumented immigrants and providing analytical support in conflict contexts. From a purely financial standpoint, the The political orientation of a founder or the intelligence ties of a company can matter if they shape regulatory risk, brand perception, or procurement decisions. In Palantir's case, this background amplifies concerns in some foreign capitals that the company is not just a neutral vendor, but effectively a strategic asset of the U.S. security establishment. Campaign groups and civil liberty organizations have criticized Palantir's platforms as enabling mass surveillance and potential infringements on privacy and civil rights. Even though Palantir positions itself as merely a data processing provider that helps governments and corporations find useful patterns in large datasets, these criticisms shape the public climate. They make it easier for politicians to justify moves like the one France's DGSI has taken. Investors need to translate that into risk language. Reputational risk can morph into procurement risk. As more governments adopt strong data protection laws, stricter oversight of surveillance technologies, and more intense scrutiny of third-party vendors, Palantir faces more friction in winning, renewing, or expanding contracts outside the US and a few especially aligned allies. According to the same news source, we are already seeing these concerns echoed in the United Kingdom. British lawmakers recently urged the National Health Service to end its contract with Palantir. Their argument was that reliance on a small number of US-based providers creates a clear vulnerability, leaving public services at the mercy of foreign actors. In parallel, the London Mayor's office blocked an attempt by the Metropolitan Police to work with Palantir. For PLTR investors, this is a critical pattern. It is not only the French security services pulling back. A major European healthcare system has had its Palantir partnership publicly questioned by lawmakers. Local authorities in one of Europe's major capitals have intervened in a policing context. Each of these adds pressure to Palantir's image and could deter other agencies from onboarding the platform. Think about the company's long-term addressable market narrative. Palantir has pitched itself as a horizontal data and decision platform for governments and large enterprises, with potential deployment across healthcare, defense, law enforcement, infrastructure, and other sensitive domains. That story depends on a perception of stability and trust. If powerful voices in multiple countries actively question whether Palantir is a safe or sovereign choice, the growth curve could flatten in some regions. Next, let us consider the direct revenue and contract impact. The article does not specify the size or term of the DGSI contract, but intelligence and security deployments tend to be relatively high value, sticky, and margin-rich. Losing such a contract does not just mean losing a revenue stream. It also means losing a reference client in a highly influential category. When a major Western security service decides not to renew with Palantir, potential customers in other countries will pay attention. Even if there are local political or sovereignty reasons that do not apply everywhere, the optics can weaken Palantir's position in future competitive tenders. Each such loss can incrementally raise customer skepticism about signing multi-year deals with a vendor that might become politically controversial. In the short term, for PLTR stock, the market will ask several questions. First, is this a one-off or the first sign of a broader pattern? Second, how material is French public sector revenue relative to Palantir's total? Third, will management have to increase spending on compliance, local partnerships, or regional data centers to reassure other governments, potentially pressuring margins? Because public markets are forward-looking, even a relatively modest contract loss can hurt valuation if it signals a changing trajectory. Palantir is valued not only on current cash flows, but also on its perceived position as the go-to intelligence and data platform for Western-style democracies and regulated industries. If that narrative weakens, price-to-sales or price-to-earnings multiples can compress. According to Free Malaysia Today, France is explicitly linking its Palantir decision to a strategic pivot, investing heavily in domestic AI and refusing to depend on the goodwill of partners who can shut off access. This tells us something about the macro environment Palantir and other US data and AI firms are operating in. Digital sovereignty is becoming a central policy theme in Europe. Between concerns about US dominance, Chinese influence, and broad national security anxieties, governments are increasingly willing to pay a premium, or tolerate lower quality solutions, for the sake of autonomy. Over time, this policy preference can create a robust ecosystem of domestic competitors. From the perspective of a PLTR investor, this background matters for two reasons. It raises the likelihood that in several European countries, US vendors will be excluded from certain bids or face hidden disadvantages compared with domestic players. It also suggests that EU-level rules on data localization, algorithmic transparency, and foreign supply chain oversight may tighten, increasing the cost of doing business and the complexity of compliance. In that context, Palantir's strongest moat, its deep entanglement with U.S. national security and its advanced population-scale analytics capabilities becomes a double-edged strategic asset. It cements the U.S. government as a foundational customer, but it narrows the runway in parts of Europe that increasingly frame technological autonomy as a security imperative. How might Palantir respond, and what should investors watch for? First, expect Palantir to emphasize its role as an infrastructure provider rather than a policy actor. The company has long argued that it delivers tools, while end users decide how to collect, store, and exploit data. We can reasonably expect management to deepen that messaging, stressing contractual, technical, and governance safeguards that prevent unilateral control or misuse. Second, Palantir may have to double down on regional structures. That could include more localized data centers, joint ventures with European partners, or governance models that give host governments greater assurances about independence from U.S. legal or political pressure. Moves in this direction could mitigate some of the concerns that lead France to walk away. But they can also compress margins, as they introduce costs and operational complexity. Third, Palantir is likely to lean more heavily on its U.S. government and commercial franchises to offset any softness in European public sector demand. In practice, that could mean seeking larger, longer-term deals with U.S. defense, intelligence, or civilian agencies, and pushing harder into non-government industries such as energy, manufacturing, finance, and healthcare in markets more receptive to U.S. tech. For investors, the strategic question is whether Palantir can achieve enough growth in those other segments to offset any headwinds in parts of Europe. If the market senses that the company is effectively capped in certain geographies for political reasons, it will want to see accelerating traction elsewhere to sustain current or higher valuation levels. Let us walk through a few broad scenarios that may shape PLTR's trajectory over the medium term. One scenario is a contained impact scenario. Under this path, France's move remains relatively isolated. Other European countries do not significantly shift away from Palantir. The company adapts with some incremental localization measures, and new contract wins elsewhere offset the DG loss. The stock might see volatility, but the long-term growth thesis remains largely intact. Another scenario is a gradual erosion scenario. In this path, more European agencies start questioning or unwinding Palantir relationships, echoing the argument seen in the French and UK debates. Palantir is not banned outright, but its win rate declines, renewals become more contested, and deal size per customer either shrinks or grows slower than originally projected. Growth decelerates modestly versus previous expectations, and multiples compress as investors price in higher political risk. A more adverse scenario is a sovereignty-driven exclusion scenario. Here, a combination of EU-wide regulation, national digital sovereignty strategies, and public pressure leads several major European states to systematically favor domestic alternatives in security, health, and critical infrastructure analytics. Palantir retains some legacy deals but struggles to expand, while its European pipeline for sensitive public sector contracts is structurally impaired. The firm becomes more of a US-centric defense and commercial analytics player, with less diversified geopolitical exposure. Finally, a positive turn scenario could emerge if Palantir successfully adapts. For example, by partnering with European integrators, adopting strong data localization, and clearly separating its U.S. government-facing work from its European deployments both legally and operationally, it could rebuild trust and present itself as a neutral infrastructure provider. If that happens in parallel with continued strong traction in commercial sectors, particularly in AI-enhanced decision-making platforms, the market might ultimately view today's political noise as a growing pain rather than a thesis breaker. For current and prospective PLTR investors, what are the practical implications? First, risk assessment should explicitly include geopolitical and regulatory risk in Europe, not just in China-related contexts. The assumption that U.S. tech will always be welcomed by allies is being re-examined, and Palantir, as a strategic security vendor, is at the center of that re-examination. Second, it is worth tracking a few key indicators over coming quarters. Watch for commentary in Palantir's earnings calls about European public sector demand, contract churn, and pipeline visibility. Pay attention to any disclosures about significant contract losses or non-renewals in the EU beyond France. Monitor whether the company announces new governance, localization, or partnership initiatives aimed at addressing sovereignty concerns. Third, investors should revisit position sizing and thesis framing. If your Palantir thesis depends heavily on the company becoming the default operating system for Western governments globally, this French episode is an important data point suggesting that path may face more obstacles than previously assumed. If your thesis is more focused on U.S. government revenue resilience and commercial expansion in friendly markets, the news might be less thesis-breaking, though still relevant for downside risk considerations. According to Free Malaysia Today, the French decision intersects with broader calls across Europe to gain independence from the United States in AI development. That macro trend will not reverse quickly. For Palantir, it means the company now operates in a world where its strongest political ally, the US government, can simultaneously be a liability in terms of optics and trust in other jurisdictions. At the same time, investors should remember that Palantir's core value proposition remains powerful. It has highly sophisticated platforms for integrating heterogeneous data, enabling complex analytics, and embedding decision logic into operations. Those capabilities do not vanish because one government steps away. What changes is the ease of deploying that power in places where political actors prioritize sovereignty over pure technical performance. In conclusion, France's DG dropping Palantir is a meaningful warning sign about the political headwinds U.S. security tech firms can face in Europe. For PLTR investors, it underscores the importance of monitoring regulatory and geopolitical context, not just product roadmaps and quarterly numbers. The long-term outcome will depend on how effectively Palantir can adapt its governance, reassure foreign partners, and diversify its growth engines. That wraps up this episode. Thank you for listening, and if you found this analysis useful, consider subscribing so you do not miss future deep dives into the intersection of markets, technology, and policy.